They convince themselves it is temporary, that the market is mispriced, that they simply need more time. The longer they wait, the more emotionally, financially, and psychologically weighted the loss becomes. It is no longer a number on a screen. It becomes an identity. Letting go now would be admitting defeat, and pride is often stronger than reason. I have been there. I once held a position far beyond my stop. I had excuses for every movement, every flicker of market noise. But the excuses did not change reality. I lost more on that trade than I had in the previous 5 combined. It was not the market that destroyed me. It was my refusal to obey my own limits. A small loss is a trade. A large loss is a mistake. The difference lies in timing, in discipline, in the ability to act decisively when needed. Every second delayed hands the market control of your account, and that is a cost no trader can afford to ignore. The traders who endure understand that the market is indifferent to skill, to hope, or to ambition. They recognize that the smartest move is often patience. They accept that most losses cannot be prevented, but the size and frequency of losses are controllable. They learn to cut losses quickly and decisively, without hesitation. They do not cling to positions in denial. They respect the tape, the structure, and their own rules. Most traders do not build systems. They chase setups without comprehension, follow rumors, and allow feelings to dictate actions. This is not trading. It is gambling disguised as skill. Instinct alone is unreliable. What feels right today will often seem foolish tomorrow. Only a system tested, refined, and executed consistently provides protection against the chaos of price movement. A system need not be complex. It must be clear, repeatable, and disciplined. Execution must follow the rules every single time. Without it, even winning trades teach false lessons, and losing trades can erase months or years of progress. Emotions are silent destroyers in trading. They do not shout but whisper, coaxing you to stay in a position too long, ignore your stops, and doubt your rules. Fear appears first when a trade moves against you, not because the loss is unbearable, but because admitting you were wrong is. Fear freezes your hand when action is needed, convincing you to wait, to hope, to believe the market will reverse just for you. The market does not reward belief. It rewards execution. Greed, on the other hand, arrives during wins. A profitable trade tempts you to abandon your plan, chase more, or overextend. Decisions once clear become clouded by emotion. I have felt both. I have exited trades prematurely out of nervousness and held others too long chasing fleeting profits. In every case, following emotions cost more than following rules ever would have. Discipline is not the absence of emotion. It is the ability to act despite it. It is clarity, consistency, and the courage to obey your plan even when instincts scream otherwise. Your strategy is only as strong as your ability to execute without interference from fear, greed, or hope. Bigger size does not equal bigger profits. It equals bigger risk. Most traders underestimate this truth. The risk is not in how right you are, but in how wrong you can be and how fast you can stop the damage. I never entered trades at maximum size. I tested, confirmed, and gradually increased exposure. If a trade proved valid, I added. If not, I stepped aside. Protection, not ambition, dictated my approach. Many traders, driven by impatience or pride, enter oversized positions only to panic at the first pullback. Losses then compound because exposure was excessive, not because the trade itself failed. Patience allows one to identify the waves that align with their edge, riding them further and more profitably than those who act indiscriminately. Advice is abundant. Brokers, friends, and strangers all offer opinions, yet the market rewards only those who make their own decisions, grounded in their own analysis. Trading based on someone else's conviction is exposure, not strategy. I have followed tips and recommendations only to learn the harsh lesson that the market punishes reliance on others' thinking. When decisions are outsourced, the framework for recovery vanishes. Trust must be placed in observation, analysis, and the systematic application of rules. Success is measured by the ability to act independently, execute a tested system, and accept responsibility for outcomes. Cutting losses quickly and letting winners run is the core principle that separates the survivor from the casualty. The market presents both paths, one of guesswork and regret and one of observation and disciplined action. Both are available every day, but only one ensures long-term survival. discipline, structure, patience, and the consistent application of rules are non-negotiable. Traders fail not due to ignorance, but due to the inability to implement principles under pressure. Emotional interference leads to premature exits, hesitation on losses, and the repetition of avoidable mistakes. Mastering these behaviors, cutting losses without hesitation, and allowing profits to grow creates a buffer against chaos. This simple but profound principle is what divides those who last from those who disappear. The edge in trading is never hidden. It is revealed through consistent adherence to rules, thoughtful reflection, and the patient application of tested methods. Principles like discipline, structure, patience, and control are timeless, unchanging, and unforgiving in their consequences. A trader who respects them gains clarity, confidence, and longevity. One who ignores them learns only the harsh lessons of repeated losses. Most traders fail because they underestimate the cost of ignoring these truths. The market is not cruel, it is impartial, indifferent to hope, pride, or desire. It responds only to action grounded in preparation, analysis, and disciplined execution. Understanding this distinction is essential. The difference between success and failure is rarely a matter of intelligence. It is a matter of behavior under pressure, the ability to resist impulses, and the strength to follow rules consistently. Those who master this behavior position themselves to endure, adapt, and ultimately thrive in a market where the majority fail. The ability to endure drawdowns, to manage size, and to limit damage ensures that opportunity can be exploited when it presents itself. Without risk management, even the most accurate predictions cannot protect capital or maintain psychological stability. Consistency in execution requires a system that is both logical and repeatable. A system eliminates ambiguity and provides clear instructions for every trade: entry, stop, target, and conditions for adjustment. Without this framework, every decision is colored by emotion and every trade becomes a guess. Traders who lack systems rely on instincts, tips, or perceived patterns, which often lead to inconsistent outcomes. A tested system does not promise victory on every trade, but it provides a consistent approach that maximizes the probability of success over time. Discipline and patience applied to a robust system compound, creating an edge that no amount of guesswork or impulsive action can replicate. The system is not a guarantee, it is a guide, a map through the chaos, and the foundation for sustainable results. Learning from losses is paramount. Each mistake, each losing trade, provides invaluable data if approached with honesty and rigor. Traders who ignore these lessons, who bury mistakes under rationalizations, doom themselves to repetition and failure. The market does not forgive ignorance or denial. Recording, analyzing, and refining after every loss builds insight and strengthens decision-making. Conversely, avoiding reflection ensures that the same errors will recur, compounding risk and diminishing confidence. The most successful traders embrace loss as a teacher, not an adversary. They understand that each setback is an opportunity to refine technique, strengthen discipline, and deepen understanding of both market dynamics and personal behavior. The market also teaches the value of humility. Even experienced traders are reminded repeatedly that no strategy, no insight, and no intuition is immune to failure. Market conditions change, volatility shifts, and trends reverse unexpectedly. Humility allows traders to accept the limits of control and focus on what they can manage: risk, discipline, and execution. Arrogance, on the other hand, blinds the trader to danger, encourages overconfidence, and magnifies losses. I have witnessed traders destroyed not by the market itself, but by the arrogance of assuming they could outthink or outmaneuver it. Respect for the market's impartiality is not optional. It is a requirement for survival. Finally, the distinction between activity and productivity cannot be overstated. Many traders equate busyness with skill, believing that the number of trades executed reflects their expertise. The market does not reward busyness, it rewards precision, timing, and adherence to rules. Each unnecessary trade introduces friction financially, psychologically, and operationally. The true edge lies in executing high-quality trades based on preparation and analysis, not in acting on every impulse. Some of the most profitable traders I have known achieved their gains through restraint, patience, and focus. capitalizing on select opportunities while ignoring distractions and noise. Productivity in trading is measured not by quantity, but by the quality and consistency of decisions executed under pressure. Trading is not a sprint. It is a marathon. The market is a relentless teacher, testing endurance, patience, and self-awareness daily. Long-term success requires more than intelligence or a clever strategy. It demands the consistent application of principles over years. Many traders start with enthusiasm, believing that the next trade will bring instant wealth. That excitement fades quickly when reality hits, when losses accumulate, and when emotions take control. Survival, not brilliance, is the first milestone. Those who endure understand that every trade is a test, and every setback is an opportunity to refine discipline and strengthen resolve. Fear drives premature exits, greed prompts overextension, and hope prolongs losing positions. Awareness of these forces is insufficient. The trader must integrate this awareness into a disciplined framework. Containment of emotion allows logic to prevail over instinct. It is not the absence of feeling, but the mastery of response. Emotional control preserves capital, maintains clarity, and enables consistent execution. Traders who cannot manage internal turbulence invariably succumb to external volatility. Discipline and emotion are not opposing forces. They are partners in sustainable performance. Another defining trait of long-term success is the understanding that small, consistent advantages compound over time. Traders who focus on executing rules, managing risk, and maintaining clarity gradually build an edge that grows exponentially. Instant success is rare. Durable results are cumulative. Each well-executed trade, each disciplined response to adversity, each lesson learned compounds into a foundation for future gains. This principle extends beyond individual trades to entire careers. Patience, reflection, and adherence to systemized methods create resilience. Those who respect this compounding effect develop confidence without arrogance, allowing them to navigate losses and wins with equal composure. Learning from others is useful, but reliance on external opinions is dangerous. The market does not reward borrowed conviction. Following tips, rumors, or popular sentiment without independent analysis exposes a trader to unnecessary risk. Every decision must be rooted in one's system, research, and readiness to accept outcomes. External influence can supplement understanding but cannot replace personal judgment. Trust in one's own process is paramount. Every trade executed on borrowed belief is a step toward dependency and failure. Mastery is achieved when the trader can act decisively, independently, and consistently under any market condition. Ultimately, survival and success in trading come down to consistent principles applied over time. Cutting losses quickly, letting profits run, executing a tested system, managing risk, maintaining emotional discipline, and exercising patience are not optional. They are essential. These principles do not change with market trends, technology, or news cycles. They are timeless. Traders who internalize them separate themselves from the majority who succumb to emotion, greed, and impulsive behavior. The market will always offer opportunities, but only those prepared, disciplined, and consistent can capitalize sustainably. Learning these lessons is difficult, but the rewards are lifelong. Trading is a reflection of character. Every decision, every reaction, every adherence to principle reflects discipline, patience, and awareness. The market is not the enemy. It is a mirror. It exposes strengths and weaknesses, rewards preparation, and punishes hubris. Traders who succeed treat losses as lessons, gains as validation of disciplined execution, and adversity as an opportunity to refine skill. Success is not measured by individual trades, but by longevity, consistency, and the ability to learn from every experience. The trader who embraces this mindset achieves more than profit. They achieve mastery over themselves and the market alike. The final distinction between those who survive and those who fail is the ability to act despite uncertainty. The market never provides certainty, only signals, probabilities, and data. Waiting for perfect conditions or complete confidence is a trap. Traders must act decisively, guided by system, analysis, and risk parameters. Indecision is costly. Hesitation magnifies losses and erodes opportunity. Mastery involves understanding the balance between patience and action. Knowing when to wait and when to act, and doing so consistently, separates professional traders from amateurs. This skill is developed over years through experience, reflection, and adherence to disciplined practice. In conclusion, the path to trading mastery is defined by discipline, patience, emotional control, risk management, reflection, and adherence to a tested system. Knowledge and strategies are tools, but without execution, they are meaningless. The market does not reward intent. It rewards action executed with clarity and consistency. Traders who internalize these principles create resilience, preserve capital, and achieve long-term profitability. Those who ignore them succumb to emotion, impatience, and randomness. The choice is simple: follow timeless principles or become another cautionary tale. The market is impartial, unforgiving, and unchanging, but those who respect its rules and master their behavior thrive. This is the ultimate lesson, the essence of trading mastery.